$74,600. That is the average cash cost to mine a single Bitcoin right now. New data from public miners shows how sharply expenses have climbed. The headline number is the direct cash cost per coin. That includes power, hosting, and day-to-day operating costs. For many listed miners, that figure now sits around $74,600. But the full picture is even tougher. When you factor in depreciation of machines and stock-based compensation, the all-in cost rises sharply. On that basis, the total production cost per Bitcoin reaches roughly $137,800. This gap between cash cost and all-in cost shows how capital-intensive mining has become. Hardware fleets must be renewed. Balance sheets carry the weight of past expansion. At the same time, the broader economic backdrop is difficult. Energy prices remain elevated in many regions. Financing is more expensive after years of higher interest rates. Equity markets are less forgiving of weak margins and dilution. For miners, every block reward now carries much thinner room for error. If the Bitcoin market price trades below the cash cost for long, weaker operators feel the pressure first. They may shut down older, less efficient machines. They may sell more of their treasuries to stay afloat. In extreme cases, they may restructure or exit the industry entirely. This can lead to consolidation as stronger players acquire distressed assets at a discount. From a network perspective, high mining costs can cut both ways. On one hand, sustained unprofitability could reduce hash rate and slow investment into new infrastructure. On the other hand, miners who survive are often those with the lowest unit costs and most stable energy deals. That can create a more resilient, professionalized base over time. For investors, the key is to understand that not all miners are equal. Balance sheet strength, power contracts, and machine efficiency matter more than ever. A headline Bitcoin price rally will not save every operator if their costs remain far above revenue. Rising mining costs also influence supply dynamics. When margins are tight, miners have less flexibility to hold coins on their books. They may be forced to sell a larger share of rewards to cover expenses. That can add steady sell pressure during weak periods. Conversely, if price moves well above both cash and all-in costs, miners can afford to hold more, tightening liquid supply. In short, Bitcoin is secured by real-world costs that keep climbing. Understanding those economics is essential for anyone investing in the asset or in mining stocks.